Fraud is as old as man. This statement, although a little sad, is quite true. Throughout human history, we've heard and witnessed several cases of grand theft, highwaymen, conmen, and grifters. In the past 100 years of modern technology, financial crimes have only gotten more creative and common. Today, we hear of Ponzi schemes, wire fraud, money laundering, and other financial cons. But between 1990 and 2008, one man changed the world with a series of financial scams that would come to be known as the greatest Ponzi scheme of all time. His name was Bernie Madoff. Undoubtedly, the Ponzi scheme of Bernie was the most popular and biggest financial scam of all time. All in all, law enforcement officials estimated that the fraud resulted in about $64 billion stolen. I know what you're thinking. How was he able to steal this obscene amount of money? What kind of business got him access to this kind of money? Who in fact is Bernie Madoff? Was he ever caught? We'll be answering these questions in this video. This is the story of the billion-dollar scam, unraveling the Ponzi scheme of Bernie Madoff. Before we delve into how he was able to carry out a scheme of that amount of money, let's talk a little about our main character, Bernie Madoff. Bernard Lawrence Madoff was born in April 1938 in Queens, New York, and as you can guess from these kinds of stories, he came from a poor background. He was the second of 3 children born to Ralph and Sylvia Madoff. His siblings were his sister named Sandra and his brother Peter Madoff, who is quite relevant to this story. The parents were lowly blue-collar workers in Queens at the time, although the father, Ralph Madoff, would later work as a stockbroker. After finishing high school, Bernie went to college at the University of Alabama, but transferred out after 1 year to Hofstra University and pursued a degree in political science. It was during his college years at Hofstra that he got married to his high school sweetheart, Ruth Alpern, with whom he will have 2 sons, but we'll get to that later. So how did Bernie Madoff's career start? After college, Bernie enrolled at the Brooklyn Law School, but left during the year and founded his firm Bernard L. Madoff Investment Securities LLC in 1960. He founded the company with his wife Ruth. At the time, their business model was quite simple. They invest in penny stocks. These kinds of stocks belong to companies that are fairly new, and they're not yet making a lot of money. So Bernie's company at the time stocks these companies and holds them in anticipation of them growing higher in the foreseeable future. If these stocks grow, they sell and recoup their profit. But as you may guess, it's not the most lucrative way to make money, and in most cases, the losses can be devastating. He was able to get some capital to start his investment company from his personal savings and a loan from his wife's father. In totality, he got about $55,000, which is equivalent to over $570,000 today. With time, the fund started attracting more investors, and although they traded in small quotas outside the New York Stock Exchange, it started to make its name on Wall Street. During its early years, the company struggled due to economic woes in the country at the time. However, the company bounced back following more investments from Madoff's father-in-law. However, Madoff's company would gain recognition for using innovative computer information technology in the trading of stocks. Till date, Madoff is recognized as one of the pioneers of electronic trading in the New York Stock Exchange. Just so you understand how groundbreaking his discovery was, the electronic model for trading that Bernie and his brother Peter developed in Madoff Investment Securities LLC would later come to be known as Nasdaq. Madoff had forever changed the world, and with it, his fortune. In 1990, he served as the chairman of Nasdaq and would later hold a position in 1991 and 1993. In time, the company started growing exponentially, making profit in the hundreds of millions annually. His influence also started growing as he started engaging in philanthropic activities with charities in the country and abroad. He also donated thousands of dollars to political causes, much of his donations going to the Democratic Party. Now, what is a Ponzi scheme? A Ponzi scheme is a type of financial fraud where investors are tricked into investing in the anticipation of huge returns in a short period, where, in actual sense, only the first set of investors are able to gain return on their investors. Bernie Madoff's legacy, which would continue to linger in the minds of anyone familiar with his story, is defrauding his investors of billions of dollars in a Ponzi scheme spanning at least 3 decades. As mentioned earlier, Bernie's electronic trading innovation on Wall Street helped him gain a reputation in the investment and financial securities business. And if there's something you should know about Wall Street, the greater your reputation, the more likely you are to attract investors. This influence and reputation meant that Madoff Investment Securities LLC had an unending supply of investors who wanted to do business with the very profitable investment company. Reports had it that the company had to turn down some investors at some point. The general belief was that he had some very potent investment formulas which set him apart from other investment firms on Wall Street. They cannot be more wrong. The truth was that much of the investment was simply diverted into one bank account, and then when the time was right, early investors gained massive returns in exponents of their initial investments. Thus, greedy investors would eagerly reinvest this time more than the previous investment in anticipation of even bigger returns. However, not all the investors were driven by greed. Some just wanted a reliable and reputable investment company to increase their investments. To maintain some semblance of proper trading activities of these investments, Madoff directed some back-office workers whose primary job was to generate fake trades. They assigned fake trades to these early investments and backdate these trades to make it appear as though the investments were used in trading and were able to generate return. Madoff and his company ran this Ponzi scheme from 1990 until he confessed to his sons in 2008. However, Madoff had longed to be suspected of fraud even before his confession and investigation by the SEC. It was in 1999 that a man called Harry Markopolos, a financial analyst, carried out some investigation on the company's revenue numbers. In the space of an afternoon, Harry concluded that it was logically and mathematically impossible for Madoff Investment Securities LLC to make that kind of return and profit margin based on regulations. He believed that the company was committing fraud. He made findings known to the SEC in Boston in both 2000 and 2001. He was ignored on both occasions. He went further to the New York SEC office in 2005 and 2007 and was yet ignored. Much later, investigation was made into the company's business and there were several discrepancies found in them. Madoff was arrested, although he was able to post bail of $10 million. Afterward, he pled guilty to 11 felonies including securities fraud, defrauding investors, and filing false claims with the SEC. He was sentenced to 150 years in prison in March 2009. However, he died in jail at the age of 82 from chronic kidney disease. After the dust settled, thousands of investors have been defrauded of their money of about $65 billion. In recent years, a fund was created to pay out the claims of both direct and indirect investors, which was in the hundreds of millions of dollars. Madoff's story remains one of the most significant financial scams of all time, and even triggered an investigation into the SEC for neglect of duty and possibly accepting bribes and kickbacks from Madoff. And that's a wrap on the billion-dollar scam, unraveling the Ponzi scheme of Bernie Madoff.